All right, good to see some familiar names. Hi, everyone. Let's get started. We have a packed hour ahead of us. Tim, I'll be with you in a second. I'm just going to kick off the session. So today's a very special event, one of my favorites today because it combines two of my passions, which is venture capital and technology, along with smart investing. So it's a two-part series, and the first time we do this at Sarwa. My name is Mark. I'm the co-founder and CEO. And for those that are not as familiar with Sarwa, we're one of the leading platforms here, born out of the region, where we're helping more than 100,000 users invest, trade, save, and everything in between. And our mission is to democratize investing for everyone. So this is why we love to do these sessions. And today we're bringing two experts with very different styles of investing that have different rules. And that's why we're bringing two experts to speak directly to them. I'm going to be interviewing them. The first one is Tim Chae. He's a managing partner at 500 Global. They're a $2.7 billion venture firm that really helps technologies scale up. So we're going to start with that. And then we have Andrew Hallam, who doesn't need an intro, but we've done many webinars together. So without further ado, we'll get started. But just one disclosure before we start: this is not investment advice during this session. This is for informational purposes. So our views are not to be considered information advice, advice or a solicitation. And please refer to our Sarwa website for our disclosures around our regulations in Abu Dhabi and in Dubai. And then we can start. Hi, Tim. How are you?
Good, Mark. Thanks for having me.
Of course. Good to see you. I guess, Tim, we can start by addressing it head on, which is to say, what is venture capital and why is it part of people's portfolios, especially in the institutional space, but it's becoming more and more, I guess, part of individuals and high net worth individuals specifically. So why do you think it's part of these people's portfolios?
Sure. Venture Capital 101. And by the way, excuse my lack of voice. I've been rooting for my Sacramento Kings in the NBA Finals for the last two games, and my voice has certainly disappeared now. But I think starting with venture capital, the definition is, it's a professional investment utilizing other people's money into investing into what is perceived as highly risky assets, startups, where the business model is creating profit and returning proceeds back to our investors, which are the limited partners, in the form of capital gains. So we, as VCs, are considered the general partners on behalf of our limited partners. And our limited partners give the general partners money to invest. And, if we do our jobs right as venture capitalists, we're hopefully helping companies get to a better stage or be able to do things quicker or figure things out that maybe, they weren't able to figure out before by themselves. And just be part of that progression of the companies from starting to finish. So that's venture capital. How is it different than angel investing in startups? It's just the real definition is just other people's money versus your own money. That's what venture capital versus angel investment, in clear differentiator is. In terms of why is it in people's portfolio or the institutionals, part of asset allocation, I think that's also, as part for the crowd that's in the audience just thinking about, and the reason you're probably attending, this kind of fireside is they're probably aware about asset allocations, for their own personal lives, right? On Sarwa, there's a Sarwa Invest, Save, Trade. It's sort of the same view for institutionals who are managing billions and hundreds of billions of dollars as well. They're thinking about how do we target a certain percentage of annualized returns of our entire holdings. So if I have, let's say, $100 billion with the B, it's obviously not going to be very easy as consumers like us today can buy US Treasuries and get 5-7%. You can't buy $100 billion worth of US Treasuries and continue to sort of collect all that stuff. So I think you have to think about the limitations of certain asset classes and what that risk reward ratio, risk adjusted returns ratio looks like So on the safest side, you have things like cash or cash equivalents. Put money under your rug, right? It's basically collecting 0% interest. And because of that, it is, dragging down your returns from what your target rate looks like. And certainly in high interest and high inflation rate environments where cash gets sort of devalued over time quicker, holding more in cash means it's actually a negative drag against the rest of the things. And then you have things like real estate, you have things like, public markets. And then you get into this section called alternative investments. And within alternative investments, you have things like real estate and all the other stuff. But a smaller portion of that is called private equity, which historically had been 5%, but now it's up to about, 10 to sometimes 20, 30%, depending on the portfolio. But of that private equity bucket, about a third of that is venture capital. So, what I'm basically trying to say, it's usually the smallest portion of the asset allocations. And the reason why investors and institutional investors have it is historically, if you make right investments into the right GPs who are doing venture capital, it is going to be the highest illiquid asset you can invest in, because you're not going to get your money back for probably 10, 15 years, but it is certainly going to be the highest yielding in terms of what you're technically earning on an annualized basis off of that. So you're basically trying to have the highest risky adjusted returns, but still be able to have the potential for the highest yield possible to help increase what cash and cash equivalents are sort of dragging down so you can hit your target.
Awesome. So it sounds like it's an illiquid investment. However, a lot of people that get into it have seen the potential to outperform definitely cash and even the S&P 500 sometimes, yet it comes with a greater degree of risk. So I want to follow on with a question and explore how similar and how different it is to investing in stocks, for example. Of course, it's about identifying great companies in both.
Yeah.
But I was listening to a podcast a few days ago where Bill Gurley from Benchmark was saying the mindset is different in venture, where it's much more about what can go right. And I want to see when it comes to 500 and specifically when you're looking at companies, is there a certain frameworks or approaches that you use for investment decisions?
Yeah. So I'll start with that last question. Yeah, certainly. I think all VCs, if they do their jobs right, they're certainly looking at it from what Bill Gurley stated around what happens if this goes right versus what happens if this goes wrong. And I think that's sort of like the human psyche that a lot of people, when they're investing or trying to do something new, there's a lot of this thought around what happens if it doesn't go right, But in venture, it's all power loss, right? A lot of these companies, the reason, again, the other point around venture capital, why someone should have it in their portfolio is, I would guarantee you probably 80% of the highest valued companies come 20 years from now don't exist today.
Mm-hmm.
Right. So where's that going to come from? It's going to come from the founders who are pursuing those missions today. And then they're getting funded by venture capitalists and VCs and other sort of means to get there. So there's power laws involved with the way that we invest. The FYI, personally, I don't participate in the public markets. I don't think I'm a very great public investor. And the reason why is when I'm investing in the private markets, I know every bit of the information of the companies that I get involved with because I have a direct relationship with the founders. I'm sometimes on their board. I know what their business plans are, and it gives me a lot of satisfaction knowing, hey, I'm part of this ride for the next 5-10 years. Public stock markets, what am I doing that's asymmetrical information advantage compared to everyone else, right? I'm trying to make sense of their information based on their quarterly calls. I'm not on their board. Trying to figure out what their missions are like compared to the other competitive companies. So yeah, anyways, venture capital is all about the possibilities and the impact of what a large winner does for the rest of your portfolio. So in a stock market, maybe you're thinking about, at best, you're hoping to do like 3x in 5 years, and you're thrilled, right? Which is great. But for a win in private equity and private, venture capital, if you're taking a company from seed And then let's say the IPO, you're talking about 1,000, 10,000x type of multiple. So you do have to give yourself the opportunity to maximize your chances of finding those types of outcomes. And you're not going to find those types of outcomes if all you're worried about is the probability of things going wrong. Because 95% of the companies that you invest in are not even going to have a chance to get to that stage unless you're thinking about what can go right. And you're hoping that at the seed stage, when companies are starting and then they do get institutional capital like VCs involved, great investors at the seed round average about 3 to 4% in unicorn rates, right? And it probably means that maybe another 5% ended up exiting, but it's not that worth it. And then probably 80 to 90% of the companies exited something like 2x to nothing, meaning you lost money on it or you slightly earned money on it. But if you're thinking about the time value of money, even earning 2x over 10 years, you technically lost against what you need to be doing for your asset class, right? So it's really just the top 5% that really moves the needle for everyone. And then top 10% sort of becomes profitable, but you need to have a mindset to optimize and maximize your chances at finding those outliers. And that mindset is going to be led by what happens when this goes right.
Awesome. And I guess building on that, how do you go about balancing between diversifying across many companies so that you don't miss out on a potential big win with the need to have concentrated bets and that power law that you mentioned, where that's going to drive the majority of your returns?
Yeah, so I think diversification is important to a point. I think concentration is also important to a point. And me as a fund manager, as a general partner, anytime I'm making funds, those are part of the constraints of funds that I'm trying to figure out, right? Meaning you can't have your fund in 1,000 different companies, because that probably means that you're going to have less than 1% of the companies when these companies end up becoming big. And then let's say that out of your 1,000 in that scenario, if you had one company that's worth, $10 billion, which is great. As a seed investor, you're thrilled. But if you started out those companies with 1%, by the time that they get to a $10 billion type outcome, you're probably talking about something around the norm of a dilution of at least 50, 60% from that. So let's say that you end up with 0.4, 0.5% at the end, and more likely 0.4 if a company's at 10 billion. I mean, awesome. On a $10 billion exit, you just made yourself $40 million. That's not going to do anything for a VC fund, right? So there's an aspect around trying to get diversification so that you give yourself shots at having these outliers, more likely to have outliers in a portfolio. But there's certain concentration at play where you want to be able to model yourself in VC as a manager, that if there's a company that's more likely to succeed out of my portfolio, I want to make sure that I have ownership that's meaningful for the size of my fund that I'm operating. And I guess that goes back to the difference of like angel investing or stock investing that people on this call may be familiar with. Investments that you're making out of your own money is very different than managing a fund, because for VCs, for angel investors, or you're personally investing in stock markets, right, Mark? You're very happy if one of those deals does 3x or 5x, because you just feel like you made money on it. Mm-hmm. For VCs, what's important for us is we have to make sure that all of our gains are offsetting the losses on the other side, and they're big enough to essentially make the profits for us when the fund size is there. So that's what I'll sort of state there.
Awesome. Thanks, Tim. We have Andrew that's prepping in case people were wondering what happened. And I guess following on that, you mentioned some of the return potential if you get in at seed, but what about an investor? I know 500 Global is focusing much more on the growth stage or at Series B. So maybe can you tell me a bit more about the rationale behind that shift, and how does it differ to invest in a technology company at seed compared to at a later stage?
So you're talking about, for the audience, we started out at 500, exclusively only doing very, very early stage investments, which obviously Sarwa was one of them when we got a chance to work with you guys early on. But we started out as an accelerator based in, San Francisco and Mountain View, so Silicon Valley here in Bay Area in the States. But really over time, we started in 2010, fast forward about 9 years. So about 4 years ago in 2019, we had portfolios about 2,000 companies at a time, but we're fortunate because we had about 30 companies in our portfolio that were like unicorns now, right? And there was another 100-ish that were below $1 billion, but still above 100 million. And there's a lot of things that we caught ourselves with, which is we're still very close with these founders. We're still working with these founders, and these founders have oftentimes, as they've grown, asked us for help on getting additional financing in terms of either putting our own capital in or making introductions. And then certainly we've done the introduction part, but one of the things that we got, excited about potentially doing is what is the idea around when we're starting out with, investments at the seed stage and building that relationship with the founders. I mean, theoretically, we know more about that company than anywhere else in the world, right? Outside of the founders, obviously. There's not going to be another new investor that looks at a company at the stage after we've gone in who knows more about the company. So if you think about the asymmetrical information advantage against the rest of the world, literally the rest of the world, we felt like we were the best position to make an investment decision, right? So the ability for us to put more capital in an area where we felt like we're smarter than everyone else, at least in terms of information that we had, and that's one. But that relationship, we think about VCs as building reputations and holding reputations, and founders never, as a founder myself, right? Like you just never forget your first investor, and if that first investor can also be your co-lead or a supporting at Series A, or a lead co-lead supporting at Series B, and same thing at Series C, D, and pre-IPO, I think that's pretty special, right? And that's sort of the story that we're trying to go after, is how do we support the growth of the stories, and how do we challenge our firm and our staff that as the needs of these companies grow, as they continue to compound and grow their businesses towards going public one day or being a category leader one day, how can we challenge ourselves at the firm to continue to be able to provide the appropriate level of support for these companies at these different opportunities and problems that these founders are needing to tackle? So it's been fun because it's a personal growth spurt for our firm that we get to put ourselves in front of. And to your other question around what are the sort of the investment return profiles sort of look like at Series A, Series B, and beyond, I think at growth stages, let's call it Series B, C, D, things where you're sort of thinking, these are companies that have are or about to become category leaders in a space that they've defined, or they have they're very much a challenger, but it's definitely a viable challenger into an incumbent. And we see the things at play. There's no product risk there. It's all about the market assessments and how viable we think the rest of the upside in the market looks like. And a lot of the returns that you're looking at for a lot of these successes is probably a 2, 3, 4, 5x type of a play. And that's fine. You can have the returns where your funds are probably returning something like a 2x type of a fund for the LPs, maybe a 3x if you're on the high side. So your returns on a success is maybe 10x on the high end, but really your usual wins are probably going to be 3, 4, 5x, and your massive wins probably going to be a 10x. But the benefit is your failure rates are going to be much, much, much less than than the seed investments. And at the Series A, you're probably looking at maybe a successful win. I'm not talking about like a crazy, crazy successful, like $100 billion exit, but like $1 billion to $10 billion. You're probably hoping for something like a 50 to 100x is type of the upside that you as a Series A investor will be underwriting, for the companies that you are to make your power laws at play.
Awesome. That's really helpful to get that data. And I guess building on that, what do you think are some of the most important lessons you've learned, and how have they influenced your investing approach?
I think the biggest lessons learned, and maybe more like lessons learned plus sort of things that have become so etched in stone now in terms of practice over time. The one lesson, personally, just lesson learned, not necessarily etched in stone, is I just came from a founder background before I went into investments, right? Funded by 500 myself back in 2011. And I always looked at myself as a quote unquote product guy. So when I became an investor on the other side, it was just natural that I just found myself being connected to founders who also wanted to build product, or I felt like I could help this company or this founder think about product, maybe what I thought would be a smarter way or whatever. And then that sort of bled into all types of different areas where I get excited about companies I feel like I can help, with my own hands. And the reality that you just learn maybe in the first year, transferring from like operational role, and hopefully people figure it out, right, is like those are not jobs that you as an investor should be excited about nor doing. Unless you're thinking about joining that company, there's no benefit long term to the founder or the investor, because on the one hand, for the founders, maybe you're allowing for the founder to not have to learn how to bridge that gap that they have in a skill set standpoint, or because you may be coaching them, but really you're probably doing it, or you're probably more excited. And also the thing about it is once investors sort of start getting to like specifics around the product details, like maybe what I was doing the first couple of years, it's actually received in a much more negative, impactful way for the company, because when a founder, there's this power dynamic at work, right? When an early stage founder thinks about an investor that has strong opinions about XYZ, it's different than, let's say, a product head that you hired, Mark, is giving you strong opinions about XYZ. You look at those two things very differently, but the reality is I am probably more likely to be wrong about my opinions than your product manager is more likely to be right about his opinions about what Sarwa is. But an investor's words are probably being weighted heavily or heavier on the founder side. And then, you just end up with a bunch of highly opinionated things that the founder took as gospel. And then you just, turn into a lot of these different things that you just shouldn't have done as investors, right? And then that's the definition of, I think, where overeagerness and not understanding, an investor who doesn't understand the impact of the words and how much it can impact and detriment some of the businesses that the founders are trying to run for themselves. So I think that's a huge lesson learned just coming from an operations standpoint, what I had to do. But the big thing that's like really etched in stone for me, and I think this is a common denominator all across the board of every single company I've ever met and ever worked with that's ever been somewhat successful or more, is every single company that I have invested in, and certainly will be continuing to invest in going forward, are founders and teams that know and want to move extremely fast. And I'm not talking about average speed. There's an average speed of what founders and products are launched at. I'm not talking about lines of code or anything like that. Just the overall activity of proving thesis out every day. You might have questions around, I'll give you an example. There's in a concrete example for me as an investor, I might meet with founders, a group of founders or, a team, and we do the whole whiteboarding session that I usually like to do with my founders. And then, on Team A, there's always two types of companies. On one group, it's the founders who come back to me that night with an email. It's like, did I try this? And it's not working, but I think we figure out something else. So we're going to try it. I'll let you know tomorrow once we get more information. Right. And then there's the other team where I meet with them a month and I'm not hearing anything again, just because we're rescheduled. So we chat again a month from now. And I ask them, what happened with that? What's the result of that whiteboarding session we did last month? They're like, oh, I don't know. We're still debating it. Like that company, I would never put a single more dollar into that company, because there's nothing. I'll tell you this, Mark. There's no reason. There's no physics in play in the world where a startup should actually succeed. You have no money, you have no brand, you have no reputation, you have no talent, and you certainly have no resources or strategic or political pull against any of the incumbents in the industry that you have. Guess what you do have as a startup? Speed of execution and not over debating ideas and trying to be super smart about things. Is you have to go and build and try and see what the market adapts to. And if you as a founder, I'm not saying you, Mark, you're playing it fast enough, but like when I chat with other founders who just don't understand that, for me, it's the biggest turnoff ever. And I think that's the part that I want people in this room to think about too, which is like, there's really no reason startups should succeed, yet we see it all the time. Common denominator being that incumbents are slow to move to a new opportunity, or incumbents are slow to move to change and when disruption starts to come into place. Incumbents are slow to decide on even product launches because there's so many voices. They're doing everything by a committee, and I hate things in a committee, right? Whereas the founder, you're a crack team. You're going in there like a SWAT team and you're building it out and trying it. So you do have to act like that. So I think that's been the biggest lesson learned in terms of what's been etched in stone for me.
That's excellent advice, Tim, for not just investors, but a lot of the founders also that are hopefully on this call. I want to move on to maybe common mistakes that you've seen some of your peers or venture capital investors make in general.
Yeah, I mean, I think a lot of that, the operational thing that I was telling you about, I see that a lot. And I have some of my colleagues at 500 also, doing that. And I've had the chances to sort of like for the, the latest ones that we brought on board who came from operations. And I shared my experience like, hey, I think this is a common thing that I just see, see if you can see this within yourself as well. And hopefully that allows you to learn faster, right? Versus taking a year or whatever. So that's a common thing. I also think about common VCs very, very, I think there's like buckets of VCs. I think there's people who respect and truly respect and understand. Because acknowledgement is different. I think understanding and respecting the integrity and how hard and difficult it is to be a founder. And then I think there's VCs who don't. Right. And I'm not saying that the VCs in that latter bucket are rude. What I'm just saying is people who haven't been creators or been around builders and creators, it's really, really hard to fathom how difficult it is to figure out answers and always going from 0 to 1, flipping a switch and figuring things out. And the whole sort of journey of all that sort of entails. So I think that humanness is very, very important, right? And I think certainly over the last 10 years or so, you've seen a rise of VCs where you probably can name a lot of founder or investors who probably fit in that former bucket of someone that you really do trust that has that respect and understanding of being a founder. And that those investors are not necessarily telling, oh my God, I know how hard it is. Like they're not doing that, but you get it when you're chatting with them. But the other investors in the bucket, which have been like the old decades of generation, and there's certainly new investors that still come into market today of it. They're looking at startups as a spreadsheet, no different than private equity. And I think there's a lot of good values that sometimes founders can take from some of those types of investors. But the common fallacy, just like I said, the common fallacy of founders turned or operators turned investors are on wanting to get involved in product. The common fallacy of a lot of people who maybe just come from like the world of finance and they're looking at startups as no different than an asset versus trying to figure out the inner workings of different things, and they're looking at it from a 30,000 sky view standpoint. I think there's a lot of things that is hard to comprehend before things actually take shape. So what I mean by that is, Mark, if for Sarwa 6 months from now, let's say XYZ things work, we knew it was going to be most likely the case because of the things that you've been doing for today, last 6 months, last 12 months that we're working towards these things, right? But there's certain things that may not necessarily be on growth rates, but there's milestones that you can predict will be coming if you really, truly understand the business. But for a lot of the spreadsheet-based investors, when they're looking about sort of the strategy and maybe the growth of what you're trying to do, a lot of those details are missed. So they tend to miss it unless that actually does happen. It's a check mark for them versus the probability of something happening as you're sort of progressing through that chain. And that affects it in multiple different ways. So that mistake is causing for founders to feel like, hey, either this guy's an a-hole or this guy doesn't understand my business. Or in often cases, those investors don't necessarily get the chance to see the true picture of the business and then miss out to other investors who do. And so you never really get to be on the cap table of some of the great companies because you just don't understand the inner workings of a lot of these things that are happening. So I don't know. I just wanted to give two common examples of maybe, types of investor on both sides of the table. But, I've seen those two things a lot.
Yeah, I can relate a lot to that, especially when you value information that much. That's how you're gonna get it and build that proximity. To close off, Tim, that's been really insightful, but I want to just put it into practice for the audience. You're on our board. You've helped us a lot, expand our product suite. But I want to take us back to 2021 when we were working closely together during the investment period. When investing in Sarwa, what was your thesis and how did it evolve over time? Just to give people a flavor of the level of detail or the reflection that you were going through during that period.
Yeah, I mean, I think, the benefit of 500 is that we don't have to be fortune tellers of what the world is going to look like. I think we have the benefit of not being able to do that because we invest so globally and we see what's happening all across the world, right? And our thesis and philosophy is consumers, whether they're Emiratis or they're expats or they're Americans or they're Koreans or whatever it is, as long as the consumers' products that they use, like the physical hardware devices and the threshold of credit card penetration, the GDP, disposable incomes, internet speeds, mobile connectivity are all there. Most consumers want the same things in the world. Like that's what it turns out. So for Sarwa, I think it was interesting because, there's a lot of things that I felt like the growth of, or the bull runs of what crypto and things like Robinhood was telling me, not necessarily the business models per se, which is you're just going to see the biggest difference is I think for the next generation, the millennial generations and the Gen Zs and the Gen Alpha is coming up. The relationship that these people have with their money is going to be vastly different than what the boomers, the Gen X, all that sort of are going to have viewed their money as, right? I think a lot of the millennials, Gen Zs, and even alphas coming up are going to be looking at is, hey, money's yours, and you should be entitled to be literate about what you need to do for your own money's sake. And so I think a lot of the no value add money managers are going to be out of a job, as they should be. Right. I think a lot of people just want the ability to learn for themselves, learn what an ETF is, learn what a good platform is, so that they can just park their money and not forget about it, and just forget about it or whatever, without paying on crazy fees. Right. And I think that consumer relationship, that behavior, that want, I think exists everywhere in the world. And to tap into that, you have to have certain disposable income. So the business model of the company that's actually trying to serve on it can actually make some money and not die. But there's also the ability around, how do you approach it in markets, and is it legal? Is it possible to even get these things done? So that was the big thing for Sarwa, in my opinion, right? It wasn't, because I think when we invested, you guys were just doing the robo advisory, like the park it and
That's
sort
right.
of let us grow your kind of stuff. And then we had the conversations, which is it's I think there's an importance to thinking about trading and even crypto, not necessarily to say that I felt like any one of those things are specifically, something we need to be building for. But if you think about the customer profile of what I felt like Sarwa is really, really tacking on, which is the investors, the newer generation of investors who want to manage their own money, and they've never parked their money elsewhere, or they don't know what a wealth manager is, nor would they want to work with them anyways. They're going to want to have a little bit more agency in the things that they do, right? Maybe they're not even doing crypto, but why doesn't Sarwa just let them explore? Because that's the customer we're trying to service, right? So I think that was just the thesis across the board. And you guys, I think people who use you like using you guys, and beyond the growth that you had, I think just having worked with you at a firm level for years before that, I think gave us a lot of comfort to be able to work with you further, and hopefully be able to really bring this vision home, or see you guys really bring this vision home within that region. And really, I mean, it's beyond that now. It's just great. I think we nailed the coffin on the head, right? Which is turns out that is your customer base. No one really cares about one single product. And the people that you're bringing in aren't like the crypto nerds, aren't going to be the trading nerds, or it's none of that. it's just people who want to be able to have flexibility and agency in the money that they're managing for themselves. And it could be in crypto, it could be in trade, it could be in, you know, ETFs and robo advisory, but they get to make their own portfolio worthwhile. And that's like going to be the core group. And so I think there's validation there. And now it's just, how do we, you know, the question is going to be, how do we get Sarwa from into everyone in the GCC and, you know, and beyond. And I think that's going to be probably the growth of what Sarwa looks like for the next 5-10 years.
Thank you so much, Tim. There's never enough time with you, but I do have to put a stop there. A lot to learn from, and we'll be just sharing that recording after we take some snippets. But really appreciate your time to just share your story around venture capital and the Sarwa piece as well.
Sounds good, Mark.
Awesome.
Okay.
Bye, Tim.
All right. Thanks for having me. Bye.
Pleasure.